Hello, I'm John Ward on behalf of Physical Gold Fund at Anglo Far East, and we're delighted as always to have with us here Jim Rickards. Mr. Rickards is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for the Physical Gold Fund. Jim is the author of the New York Times bestseller Currency Wars, The Making of the Next Global Crisis. And more recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System, also a New York Times bestseller. Hello, Jim, and welcome.
Hi, John. How are you?
I'm very good, and I'm looking forward to today's discussion, especially because it's about a question that's important, I think, for all investors in precious metals, and that subject is price manipulation. But first, let's do a quick roundup on the current situation. In our last podcast, you offered us a multifaceted analysis of the crisis in the Ukraine and the accompanying financial war between the US and Russia. So let me ask you, Jim, has anything happened since we spoke to modify your picture of that crisis and its implications for the global economy?
Nothing has really changed in terms of the long-term implications, John. In terms of kind of what's going on the ground, of course, we do have what looks like a ceasefire between the Ukrainian rebels, obviously backed by Russia, and the government in Kiev. So that's a good thing, certainly for people on the ground, the innocent victims of all this. So we have a ceasefire. It seems to be holding. That's significant. But to me, the significance of the ceasefire is that Putin's getting what he wants. In other words, this is not a case where Putin has backed off or backed away. I think the markets have interpreted it that way. They've said, the sanctions are working and Putin's been punished and he's backing off. That's nonsense. The sanctions are not working. Putin not only has not been punished, he's actually getting a lot of gains. And so the reason there's a ceasefire is because the Ukrainian government forces had gone into pretty much full retreat. The Russian-backed forces, including Russians themselves, had gone on the offensive. And so it was in everyone's interest. In other words, it was in the Kiev government's interest to have a ceasefire because they were in retreat. It was in Putin's interest to have a ceasefire because he was getting what he wanted. And also, it's kind of good PR if you want to think of it that way. So again, the ceasefire is good from a humanitarian perspective, but I would not infer that it means that Putin has backed off at all. It just means that Putin's getting what he wants. And so therefore, looking into the future, nothing has really been resolved. Putin is going to, I think, insist that either these Eastern Ukraine republics become true republics and perhaps join the Russian Federation. Remember, Russia is the governance in Russia it's a federation. It's called the Russian Federation. There are multiple members. Russia is one of them, but you have others. And so I think these two sort of nascent or putative republics in Eastern Ukraine could possibly join the Russian Federation. So good news that there's a ceasefire. Markets have calmed down, but I would not. This is far from over. And if the West and Kiev and NATO are going to insist that Russia back off, and if Russia is going to insist that these republics break away, then it's really not over. So I would look for it to flare up again. But at least for now, we're in a quiet period.
Well, thanks. So let's turn to our topic of the day. And to give a little bit of framing for that, we're going to be talking about the gold price. Let's just briefly touch on the current story of the gold price. Gold and silver actually are both been under some pressure the last few weeks. And I recall that in several of these conversations, you've advised us, don't look too closely at the price of gold. Don't get, fret about the ups and downs. It's what we would expect and doesn't alter the big picture. Nevertheless, I think some investors in gold may be a little anxious about a significant drop in the price over the last few weeks. So maybe you could help us understand that, what's driving that and how to think about that strategically.
Sure. And absolutely, if you're a large investor in gold, no one wants to see the price go down from an investment perspective. But I think it's always important to do two things. Number one, keep your eye on the long term. That's the reason you own gold to begin with, and not get too distracted by day-to-day movements. But number two, also understand what's going on behind it. And why is the price of gold going down? I think understanding why in any market is a source of comfort. If you think it's out of control or it's just going to go one way forever, that's one thing. But if you can understand that it's a blip and what's driving it and see how that driver can reverse, then I think that's a source of comfort. So let's just kind of take those in order. Again, the reason to have gold, and I've always recommended, maybe 20% gold for the aggressive investor, but in most of my writings and interviews, I've recommended 10% gold for the conservative investor. So, when the price of gold goes down, you face a certain amount of criticism. Say, you said buy gold or you recommended gold and it's gone down, and you do get some complaints about that. But it's not as if anyone ever said go 100% in gold. I mean, the fact is, if you're 10% in gold and gold goes down 20%, that's only a 2% decline in your portfolio. Presumably, you've got other things in the other 90% that are doing well. I know I'm an investor in gold, but I also invest in fine art. Fine art has done well. I don't have a lot of stocks, but if you're a stock investor, that's done well. I've got some private equity that's done well. So I don't worry too much about the gold. It's a slice of the portfolio, but it's not the whole thing. So I think the first thing for investors to understand is that you should never be all in. You shouldn't even be 50% in. But if you were 10% in and it goes down, it doesn't have that big of an impact on your portfolio because it's really, it's 20% of 10%, which is only 2%. So that's the first thing. The second thing is, for people who are watching it, this looks like a good entry point. I'm not saying it couldn't go lower. It might. But gold has shown a lot of resilience. It's had several drawdowns recently, and it has come back pretty strongly both times. So this is the third drawdown in recent months. I'm impressed with the resiliency. We all know that gold is seasonally strong in the fourth quarter, so we're coming up on the fourth quarter in a few more weeks. Obvious reasons for that, having to do with the wedding season in India. Demand in China, it continues to be very strong, and the physical supply continues to be scarce. I actually met with a gold dealer recently. I just returned from Australia. Met with one of the largest bullion dealers in Australia, and they said that their best months were when the price of gold was going down the most, because, of course, when we say the price, what we're really talking about is the COMEX price, and that's subject to a lot of manipulation, and we'll come back to that later in the interview. But people have common sense, and when the price goes down, they see a bargain. And this individual told me that her customers were lined up, out the door and around the block, so to speak, to buy gold. So if you don't have any gold, this could actually be a very good entry point. If you have some gold but want more, again, same thing. It's a good entry point. If you're a buy and hold investor, which is, I think, a good posture to be in, I think it's important to understand why the price of gold has gone down. It's a very simple explanation. Gold, the dollar price of gold is simply the inverse of the dollar. It's that simple. So you have a strong dollar, that means a weaker dollar gold price. If you have a weak dollar, that means a higher dollar gold price. It's not that complicated. So right now we have an extremely strong dollar. You look at the euro, it's come down from about 140 to 128. The Chinese yuan is down. The Japanese yen is down. Reserve Bank of Australia just cut rates. They're trying to cheapen the Australian dollar. Even the pound sterling, which had been the heavyweight among currencies, was down because of fears about the vote in Scotland. So you look around the world, the dollar is it's king dollar again. So you would actually expect the dollar price to gold to go down on a strong dollar. So the question investors have to ask is, can that last? Is that the new state of the world? And the answer is absolutely not. And the reason is that the United States has allowed the dollar to appreciate and allowed these other currencies to go down because these countries desperately needed help. The Japanese economy is in terrible shape. They fell off a cliff in the second quarter. The European economy is back in a recession, the second recession inside this depression. So they actually needed the help. The U.S. allowed the dollar to go up, allowed the yen and the euro to go down, kind of throwing them a lifeline. Chinese yuan, the U.S. does not want that to be weak, but it went down anyway because the Chinese government manipulates it. And, of course, sterling has stubbed its toe over the whole Scottish referendum. So taking that all together, we do have a strong dollar, but the United States is the one that's ultimately going to need the help. We have a very weak economy. As I've said before, the Fed has tapered into weakness. It's showing up in the data where we had a lousy August employment report. The most recent PPI and CPI reports show that deflation is more of a concern than inflation. And when you're worried about deflation, you've cut interest rates to zero and printed trillions of dollars and done everything you can. The only way left to get inflation into your economy, which the Fed wants, is to cheapen your currency. So I look for a cheaper dollar ahead, and that means a stronger gold price. So the reason gold has gone down is because the dollar is so strong. The reason it's strong is because we've let the euro and the yen cheapen. This is what the currency wars are all about, because they needed help. But pretty soon that cycle is nearing an end. The dollar is going to get weaker because the Fed's going to need some inflation here, and that means a stronger gold price ahead.
So thanks, Jim, for that clarification about the current price. And now let's turn to this subject of manipulation. And you've said a number of times in these conversations that the gold price is manipulated. And I want to ask you about the implications for investors, but let's take this step by step. Could you first review with us how the manipulation works? And after that, let's look at the possible culprits. So first, what does it actually take to manipulate the price of gold?
Sure, John. If your goal is to keep the price of gold from going up, or at least going up in a disorderly way, you only have to manipulate when it's going up a lot. So if gold's going down for other reasons, and we mentioned the strong dollar is one of them, you don't actually have to manipulate it. If it's going down, then if you're a central bank who wants a weak price of gold, you're getting what you want. So the manipulation really kicks in when gold is strong, when gold looks like it's breaking out. And of course, we saw that in August 2011 when it was rapidly approaching $2,000. That was an important psychological barrier and could have gone up a lot higher from there. And the central banks really did have to sort of pull out all the stops to drive the price down. So when gold's going up on its own, that's when you look for the manipulation. If it's weak for other reasons, then the central banks really don't have to do very much. But let's look specifically at the techniques. The first and easiest technique, and the most obvious, is just to dump physical gold. If you're a central bank, sell gold. Well, that was done for decades. You go back to the 1970s, after Nixon went off the gold standard, of course, the price of gold began to skyrocket. It started the decade in the 1970s at $35 an ounce. After Nixon's shutting of the gold window, it went up to about $42 an ounce. Then they abandoned the official price completely. Currencies floated, and gold began its sort of steady ascent all the way to $800 an ounce in January of 1980. Well, on that path from $42 an ounce to $800 an ounce, the United States tried desperately and secretly to suppress the price of gold with gold sales. And this is all described in Chapter 9 of my book, Chapter 9, Chapter 11 of my book, The Death of Money. But the United States sold about 1,000 tons and prevailed upon the IMF to sell 700 tons. So the U.S. and the IMF together dumped 1,700 tons of physical gold. That's a lot of gold. It didn't work. So at the end of the day, they just gave up and let the price of gold go where it was going to go. And then we had that super spike up to $800 an ounce in January 1980. But if you look at the period 76, 77, 78, and I've found what were classified documents. They've since been unclassified, but private documents between Arthur Burns, who was the chairman of the Fed at the time, President Gerald Ford, the Chancellor of Germany, all describing this physical gold manipulation. And then all the way through to the late 1990s, 1999, the famous Brown's bottom, Gordon Brown, then Chancellor of the Exchequer, dumped about 2/3 of England's gold on the market. So that was another type of manipulation. So you do have these episodes. And also Switzerland was a major seller of gold in the early 2000s. So for a long time, the way they manipulated the price was by dumping physical gold. There's a problem with that, which is you run out of gold. England doesn't have much left. Switzerland has a fair amount, but a lot less than they used to. And the U.S. decided it didn't want to sell anymore. It was happy for others to sell. Central banks did dump gold in the early 2000s and also through the 1990s. They've stopped. So now the physical dumping has stopped because people realize it's not working. They're ready buyers. They're running out of gold. And so they've got to resort to paper manipulation. So let's talk about how that works. The most obvious and easiest way is through COMEX futures. COMEX future prices long ago replaced the London gold fix, interesting word there, but the old ring of dealers who sat around on the phones with their customers and fixed a price twice a day. That, going back 75, 80 years, that might have, even more recently perhaps, that was significant. But since the creation of gold futures, the COMEX gold has really been the benchmark, and the London fix just kind of tagged along with that, if you will, independent of its own manipulation. So rigging futures markets is child's play. You just wait until a little bit before the close. You put in a massive sell order. You scare the other side of the market. They back away. Then you get into the fact that a lot of hedge funds are in gold, which did not used to be true. Gold was not a traditional hedge fund activity, but today there are quite a few who, candidly, hedge funds don't really know that much about gold. It's just another commodity to them. It could be coffee beans or corn or, stock futures or no futures or anything. It's just another commodity. So what do hedge funds do? They use leverage, they follow trends, and they have tight stops. Tight stops means if the trade works against you, you get out. So you have let's say you have a bunch of hedge funds in gold. They're leveraged with tight stops. So you come in with a big sell order. You slam the price. Now what happens is these stops start getting triggered. A hedge fund sits there and says, oh, my goodness, it's down 2%. I got to sell. They sell. Well, of course, that drives the price down further. Someone else hits his stop. They sell. It builds on itself. It's a whole cascade down. So between hedge fund leverage, tight stops, and leverage futures manipulation. That's the easiest way to do it. And we've seen that time and time again. I'm an expert in this myself, but I've spoken to other experts who have done documentary, long-term statistical studies of this, and they say the evidence is overwhelming that the price is being manipulated that way. So that's one way to do it. It's not the only way. It may not even, it's the most visible way. But another way to do it, John, is with gold leasing and what are called unallocated forwards. Now, unallocated is one of those buzzwords in the gold market, but a lot of people buy gold. They want to buy physical gold, so they'll call J.P. Morgan or HSBC or one of the Citibank, one of the large gold dealers, and say, I want to buy $5 million worth of gold, and that's however many kilos that is, and the bank will say, fine, send us your money, you own the gold. But if you read the contract, it says you own it on an unallocated basis. That's just a euphemism for the fact that you don't have designated bars. There's no group of gold bars that are kind of have your name on it or specific serial numbers that are specifically traceable to you. What it means is that the bank has a bunch of gold in a vault, and they sell perhaps 10 times as much gold as they actually have physical gold. And it's no different than any other kind of fractional reserve banking. Banks never have as much cash as they do deposit. Every depositor in a bank thinks he or she can walk down and get cash whenever they want. That's what they think. But every banker knows that they don't have that much cash. They put the money out on loan. They're leveraged institutions. If everyone showed up for the cash at once, there's no way the bank could pay it. That's why you have a lender of last resort in the form of the Federal Reserve, which can just print the money. Well, it's no different in gold. Banks sell more gold than they have. And if every holder of unallocated gold showed up all at once and said, give me my gold, please, there wouldn't be nearly enough to go around. But people don't want the gold. There are risks involved. There are storage costs, transportation costs, insurance costs. They're happy to leave it in the bank. What they may not realize is that the bank doesn't actually have it. So now the way it works is that a central bank can lease gold to one of these London Bullion Market Association banks, the big banks I mentioned, like HSBC. So let's say you have the Federal Reserve as fiscal agent of people storing their gold in New York, which is not United States gold, by the way. That's German and Dutch and Japanese and IMF and other people's gold, OPG, other people's gold. So the Fed has other people's gold. They can act as a fiscal agent and lease it, usually through the BIS, the Bank for International Settlements in Basel, Switzerland. The BIS can then lease it to commercial banks who are the LBMA members. And by the way, none of this is speculation, John. You can actually go to the BIS annual report, look in the footnotes, and they disclose the fact. They don't mention names, but they say, we, the BIS, act on behalf of central banks and commercial banks in the gold leasing market. They say that in black and white. Well, we know who the commercial banks are because they have to be LBMA members, and we know who the central banks are. So, you don't really have to speculate that this is going on. It is going on as revealed in the footnotes. So the central banks lease to the commercial banks through the BIS. The commercial banks then have title to a certain amount of physical gold. They then sell 10 times as much to the marketplace on this so-called unallocated basis. So you can see the leverage at work there, and they can sell as much gold as they want. They don't have to have the gold. They can just keep selling it. So between the COMEX manipulation, physical sales, which are less important because the central banks got spooked. They started realizing that the vaults were going to be empty. So could still be a little bit of that going on. And then the leasing, the back-to-back leasing, and then the unallocated sales, as I described. This is the toolkit. There's one more element in the toolkit, which we can get to, which is the ETF, in particular the GLD ETF, where it's another source of a physical supply. Maybe we want to talk about that separately, but there's a separate kind of manipulation that goes on there. So the toolkit is, rating the ETF warehouses, leasing and selling unallocated gold and a multiple of what you've actually leased, physical sales, and COMEX futures manipulation. So put it all together, it's a pretty powerful toolkit, and it can be used very effectively to suppress the price of gold, and it is.
Yes, indeed. And I was going to ask you about ETFs as you were speaking, because I was curious to know the relative importance of ETFs and futures. I mean, they're both sort of paper relatives of gold. Which has the more impact on the market and on the price of gold?
Well, from a manipulation perspective, the futures has much more impact. There are two reasons for that. Number one, there's a lot of leverage in futures. There is not leverage, at least not that much, in the GLD. There's physical gold and there are shares representing the gold. And there is an arbitrage that goes on, and I can explain that. But the real bang for the buck comes in the form of the futures, where you can get 20 to 1 leverage. So if I have $10 million, I can get $200 million of leverage out of it. And for $10 million of cash margin, I can sell $200 million worth of paper gold. So I think the fact that the market's non-transparent because you don't know who the players actually are. You know who the brokers are on the floor and the clearing brokers. We know those names, but we don't know who's doing the buying or selling at a point in time. And we don't know who the ultimate customer is. Only the brokers know that. So you have anonymity through your broker, and you have high leverage. So that's really the most effective way to do it. Now, GLD is interesting. It's you sort of have to know how it works and actually read through the document. But in the simplest terms, GLD is a trust, and the trustee has physical gold. It's in a vault. The GLD, and this is true of all ETFs, but I'm talking about GLD specifically. Their vaults are in London. There are a set of authorized participants, and these are what I call the usual suspects. They're the large LBMA members, so Goldman Sachs and JP Morgan and others. And the way it works is if you want to sell the ETF, you go buy physical gold. You then put the gold, you give the gold to the trustee, put the gold in the warehouse, and the trustee issues shares to you. Then you can then kind of act as an underwriter and sell the shares into the market. So when a small investor or retail investor, even an institution that's not one of these big banks, buys ETF, they are not buying gold. They are buying a share in a trust or a unit in a trust that owns some gold. But they don't have the ability to get the physical gold unless you jump through a lot of hoops. In very large size, by arrangement with the dealer, et cetera, you can. But very few investors do that. And for small investors, it's impossible. So all you can do if you don't like gold or you don't like the price action, all you can do is sell your shares. So now we've got physical gold trading one way. We've got ETF shares trading another way. They should be closely aligned, but there's an arbitrage there. And here's what happens. If I'm one of these big dealers and I see the price of gold, the physical price of gold, trade at a premium to the share, so my share gets me a certain amount of gold, but I look in the physical market and I see the same amount of gold is trading at a premium, there's almost a risk-free arbitrage. What I do is I short the physical gold and I buy the share. So in effect, I buy the share from the market, from somebody who's been spooked out of it, and I short the physical gold. Now I take the share to the trustee, I cash it in, I get the physical gold, I deliver the physical gold to cover my short, and I keep the difference. So it's kind of a risk-free arbitrage. But what that does do is it takes the gold out of the warehouse. Now, what you can kind of do is combine these manipulations. So let's say you're one of these dealers, and let's say there's demand for physical gold in China, which there is. Let's say there's gold in the GLD warehouse in London, which there is. So here's what I do. I go into the futures market and I slam the price of gold. This spooks the little guy. They start selling their shares. So that drives down the shares. Meanwhile, the smart money is saying, aha, here's a good entry point. So they're buying the physical. So the little guy is dumping his shares. The big guy is buying physical. And of course, a lot of that buying comes from China. So I'm the dealer. So here's what I do. I sell physical gold that I don't have to China. I don't have the gold, but I sell it short to China. I then buy the shares from the little guy who's scared to death, cash in my shares, get the physical gold, deliver it to China, and keep the difference, pocket the difference. That's almost a risk-free arbitrage. And so that would mean that gold, physical gold, is going from the GLD warehouse to the vaults in China. Well, guess what? I was in Switzerland not that long ago, and that's exactly what the refiners and the secure logistics people told me. They said, we're seeing 400-ounce bars, old ones, show up from London. We melt them down. We turn them into nice, shiny, new 4.9s, 1 kilo bars, and we ship those off to China. So this sort of closes the circle, if you will. So the arbitrage between shares and physical works exactly the way I described. So use the futures to spook the little guy, buy up his shares on the cheap, short the physical gold, cash in the shares, get the gold, cover the short, send it to China, and pocket the difference. So you can not only so you can create your own demand, create your own arbitrage, and then profit from it. But here's the significance of that, John. This is, I think, a very big deal. When gold is in the GLD warehouse, it's part of the floating supply. In other words, it's part of the supply that's available to support the kind of leverage trading we just discussed. When it goes to China, it's no longer in the floating supply. That goes to either end user demand, or the People's Bank of China, or their other sovereign wealth fund, their sovereign wealth fund SAFE, State Administration of Foreign Exchange, who are the covert buyers, and it goes off the market. So that's a one-way trip. When that gold goes from London to Shanghai, it doesn't go back again. It stays in China. So you can play these games for a while, but little by little, you need some physical gold. You can get a lot of leverage, but you need some physical gold to do it. And they're even starting to run out of that little sliver of gold. And this really explains the price action in 2013. Gold had been up 11 years in a row. 2013 was the first year it was down in that 12-year span. But the reason was 500 tons of gold was disgorged by the GLD warehouse, doing exactly the kind of manipulation arbitrage that I just described. Well, you can't do that twice. I mean, once the GLD warehouse gets depleted, and it's still got some gold, but it's down significantly from where it was at the beginning of 2013. You can't do that twice. There comes a time when the amount of gold left is so small that the management fees don't pay the costs. And then if you're the sponsor of the trust, you just want to close up shop because you don't want to operate at a loss. So yeah, that worked in 2013, but that's not working anymore because there's not that much gold left. So it's a big bag of tricks. It's very complicated. It's hard for everyday investors to understand. I think it's hard for a lot of gold experts to understand. But when you see through it all, you can see where the manipulation is coming from. The only comfort I would give investors, and I think it's an important one, manipulation can last for a long time, but it always fails in the end. It failed in the London gold pool of the 1960s. That failed. The U.S. dumping in the late 1970s. That failed. Central bank dumping in the 90s and early 2000s. That failed. So you've got new forms of manipulation going on now, but ultimately they always fail, and the price of gold will go much, much higher.
Let me just pick up on one tiny corner of this story, Jim, briefly. You mentioned the London fix, and you kind of were, in a way, putting in its place and saying this is no longer a very significant function in the market. But there's been in the news a lot of hoo-ha about the scandal of the London fix, and there's an investigation, and the fix is fixed. I wonder if you could explain very briefly how the fix works and what this scandal was about and what significance, if any, it has for the price of gold.
Sure. Well, let's just take a minute and talk about how the fix worked, and then sort of what the scandal was, and then where we're going with it. So the fix was basically a small number. I think it was about 5. I have to check the exact number, but I think it was 5 major dealers. And they all had customers. They all had, the customers could have been, refiners. They could have been large investors. They could have been the bullion banks, et cetera. And everybody wants to buy and sell gold. Now, gold is a funny market. It's very liquid on the one hand. When I say liquid, you can always buy and sell gold and get your money's worth. But it's also a very thin market. So usually thin markets are not that liquid, and deep markets are liquid. But here we have a market that's not very deep, but is very liquid. That actually says something interesting about the fact that there's always a demand for gold. So any market participant would be very concerned about market impact, meaning, I want to be a big buyer, or for that matter, a big seller. And I'm worried that if word gets out, the price will go down a lot, or vice versa. If I'm in to buy a lot, I don't want the price to run up in front of me. So you operate through these, you like to operate anonymously, and you don't want other people to know what you're doing. So the major buyers and sellers give their orders to the small number of dealers who make up the fix. So they know what the book looks like. They know what the supply and demand looks like. But they're trying to feel out the other side of the market. So they give indications. They say, well, I've got interest in buying a certain amount at this price, and the other guy says, well, I've got interest in selling a certain amount at this price. So what they're sort of doing is they're it's a little bit like a striptease. You show the goods a little bit at a time, and then they, through this exploratory process, this price discovery process, they would arrive at a price that would clear the market. Suddenly there would be a price, and then one guy would say, yeah, at that price I can sell everything I've got to sell, and the other guy would say, yeah, at that price all my buyers are filled. And so then they would say, okay, done, fixed, and then that would be the price at which all the transactions would take place. So it was a way of maintaining the anonymity of the customers and their buying and selling interest on the one hand, but still showing enough information and feeling each other out in such a way that you could arrive at a price. Now there's nothing wrong with that. I mean, that is the way markets operate. It's actually the way the stock market operated under the old specialist system before it was taken over by robots, computers, and high-frequency trading. And so there's nothing wrong with that if that's all it is. But two problems came along. Number one, we already mentioned, which is the COMEX became so dominant that these guys were really just sort of piggybacking on the COMEX. It wasn't real price discovery. But more importantly, they found that they could front-run their own customers. Surprise, surprise, banks are always looking for ways to rip off their customers. So the scandal was not the fix in the pure sense that I described. The scandal was the fact that the participants in the fix were using information about their own customer books to front-run their customers, actually buying and selling in a physical market away from the fix to front-run the people who were trying to participate in the fix. That's come to light. There have been investigations. There have been fines and penalties. There are ongoing investigations. There are class action lawsuits. I believe it was Deutsche Bank was one of the major dealers withdrew. Interestingly, one of the major Chinese banks has stepped up, said they'd like to become a member. No surprise there, because we'll talk a little bit. We talked about the techniques and the reasons for manipulation. We haven't really talked about who's ultimately behind it, but I think we can guess that the Chinese have a hand in this, and no surprise that they would like to become a member of that. So yeah, the scandal, it wasn't so much about the fix as it was about front-running people who were trying to participate in the fix. But having said that, it's really an obsolete system, and maybe it'll be reinvigorated, maybe it'll be done a little more cleanly going forward. But I think the world does look to COMEX as the benchmark, and COMEX is heavily manipulated. So we don't really have good reference prices for gold. What we have is theater, and people have to understand how the play is going to end.
Well, let's get back to the center of our story then. So we've looked at how manipulation works, and you've explained how it used to be done in the physical market. Now it's really done primarily through COMEX, also through ETFs, also through leasing of these unallocated contracts. The question then becomes, who done it? Who's the culprit here? Who's actually behind this manipulation? And let me just sort of reference what I see as the prevailing narrative when I look around at commentators on the gold market. And it seems to me the popular story is it's the Federal Reserve. They have a motive to drive down the price of gold in order to shore up the dollar, because of that very simple equation that you began this conversation by talking about. A strong dollar indicates a weaker gold price and vice versa. But I also recall you saying to us that the Fed doesn't really want a collapse in the price of gold because this would herald deflation. So I'm curious to know if you could unpack this paradox, the conflicting interests, I guess, that the Federal Reserve has around the price of gold.
Well, first of all, the key word in your question there, John, was motive. If you're a detective and you find a victim who's been shot in the head lying on the ground and there are no witnesses, the first thing a detective says to solve the crime is, well, who has the motive? Sometimes it's a spouse or a business partner, or sometimes it's difficult to discern, but they're the first people you question. So I think that's the right way to think about who's doing the manipulation, who has the motive. Now, there are two players in the world who have the motive to do this. One is the United States. The other one is China. But their motives are different. They're motivated by different things. Let's take the Fed. I think a lot of people have a very naive and, in my view, mistaken view of the Fed's interest here. They say, well, you've got to squash the price of gold to prop up the dollar. Actually, the Fed wants a weaker dollar. They don't want the dollar to go away. They don't want the dollar to collapse. But they do want a weaker dollar because we're desperate to get inflation. The Fed wants inflation. The Fed has said over and over for years, we want more inflation. They have a target of 2% in some of their guidance in December 2012. They said, well, it's really kind of 2.5 on a forward basis temporarily. A lot of hemming and hawing, but 2.5. Privately, one of the regional Federal Reserve Bank presidents told me he wants 3.5. That may be his personal view, but there's no doubt the Fed wants inflation. Well, the most recent figures are negative. CPI and PPI, consumer price index, producer price index, are coming in negative. We've got deflation in this country. So the Fed is desperate to have inflation. One way you get inflation is with a cheaper dollar, because imports cost more. You have to remember the United States is a net importer. We buy more abroad than we sell. And so if you have a cheaper dollar, that means import prices go up, and that inflation feeds through the supply chain in the United States. And that's what the Fed wants. So the Fed actually wants a cheaper dollar which means they actually want a higher gold price. But here's the catch. They want this progress to be orderly. And this is really the key word. It's not whether they want it higher or lower. The Fed knows that gold's going up and they want the dollar to go down. What they fear is a disorderly process. Gold can go up a little bit at a time. It just can't spike up $100 an ounce per day. Well, if you go back to the period July, August, and September, early September 2011, that's what was happening. That the price of gold was skyrocketing. It went up from 1,700 to 1,900 very quickly. It was clearly headed for $2,000 an ounce. And again, as we mentioned, that's a psychological barrier. Once you go through 2,000, it's sort of next stop 3,000. So that was getting out of control. So there's a case where the Fed did manipulate the price lower, not because they ultimately want a lower price, but because they were worried about a disorderly increase. However, the Fed's perfectly fine with an orderly increase as long as it doesn't go up too far too fast and change inflationary expectations. So the Fed will be in the market. They'll manipulate when they have to. They know the price is going up in the long run, but they just want to go up in a gradual way. So that's a little bit of nuance there that I think is lost on a lot of people. Now, let's go over to China. China definitely wants a lower price because they're buying. Now, there's this kind of, it sounds like a paradox. Wait a second, you own gold, you're buying more. Why would you want the price to go down? Well, precisely. If you're buying, you do want the price to go down. Again, they know it's going to go up in the end. They know it's going to go up a lot, but they need to buy more. They want to sort of look the United States eye to eye. Well, the United States has 8,000 tons. China's economy is over half the size of the U.S. economy. But remember, China is growing faster than the United States. In fact, China is growing a lot faster than the United States. So it's not too many years away before Chinese nominal GDP catches up with U.S. GDP. And in that world, you want 8,000 tons. Well, China officially says they have a little over 1,000 tons. We know that's a lie. We know that they actually have some larger number. Now, it's hard to know exactly how much, but 3,000 or 4,000 tons seems like a reasonable estimate based on what we do know. This is not guesswork, by the way. I mean, we have information on Hong Kong imports. We know that China does not export. We know Chinese mining output. What we don't know is the exact split between sort of, private demand and government demand inside China. But, you can estimate first approximation, say 50-50, and then tweak it from there. So we have enough to go on. So we know that China actually has 3,000 or 4,000, but I've just described why they need to get to 8,000, which is what the U.S. has, because you want a certain gold to GDP ratio. I talk about this in my book, The Death of Money. So China is a huge buyer. I mean, if you're out to buy 3,000 or 4,000 tons, remember, there are only about 35,000 tons of official gold in the world. When I say official gold, that's the gold owned by central banks and sovereign wealth funds. So I'm not including private gold, jewelry and what people have in private stashes. But just official gold, it's about 35,000 tons. Well, if you're out to buy, a little over 3,000 tons, which the Chinese are, that's 10% of all the official gold in the world. That's a huge number. Well, if China were transparent about that, made their intentions known, and if it was widely known, the price would run up like crazy. And so, of course, they don't want to show their hands. I wouldn't either if I were the Chinese. And, of course, they have a motivation to manipulate it down because they're still buying. It's like, if you were out to buy real estate, you'd start rumors that there was a toxic waste site, even if it wasn't, just to get the real estate on the cheap. And so that's the sort of thing that China's doing. Now, here's where it gets, I think, really interesting. The Treasury, we spoke earlier about the Fed, the Treasury to some extent has to accommodate Chinese wishes because China owns several $1 trillion of U.S. Treasury notes. If the Fed wants inflation and the Treasury wants inflation, which they do, and we talked about that, and you're China and you're saying the value of inflation erode the value of your Treasury holdings, then your incentive is to dump Treasuries, which would raise interest rates in the United States, which would sink our stock market, our housing market. The Treasury doesn't want that. So China says, fine, if you don't want us to dump Treasuries, you have to let us buy gold because that's our insurance policy against inflation. So if you guys want to inflate your currency and steal from us in the form of making our Treasuries worth less, that's okay as long as we have enough gold because we'll make up on the gold side what we lose on the Treasury note side. So China's buying gold not to launch a gold-backed currency, at least not in the short run, but to hedge their treasury position, the treasury has to accommodate that, or else China will dump the treasuries. And so you have this strange condominium of interest where the treasury and China are on the same side of the trade saying, yeah, we've got to let China get more gold. And by the way, this is something I've discussed with senior officials at the IMF, and they've confirmed, the understanding that this global rebalancing of gold from the west to east has got to take place. China has got to be allowed to get the gold. So here you've got the treasury letting China, manipulate the market so China can buy gold more cheaply. You've got the Fed occasionally manipulating the market, not all the time, but occasionally, so that the price rise isn't disorderly. But where does it all end? Where it ends is when China has enough gold, and then they do reveal the amount they have, and they're done buying, and the inflation kicks in, and then the price of gold skyrockets. But at that time, the Treasury and the Fed will be comfortable because China will have, 8,000 tons. The U.S. has 8,000 tons. Both countries will be winning on the price of gold. The losers will be people who don't have gold and go out to buy it and find out it's too late.
So, Jim, I want to return to a point that you touched on briefly, but I think is critical for those listening to this story about price manipulation. And that is the implication for investors, because when you hear about the enormous forces brought to bear on the price by these are national forces, the United States on the one hand, China on the other hand, how does the investor stand up against such forces? There would be a temptation to say, I can't win against these players, therefore it's not worth the risk of me being in this market when these guys can manipulate the price.
Well, in the short run, you can't beat them. That's correct. But in the long run, you will always beat them because these manipulations are finite, and there is an end game in play. In terms of why it's finite, first we'll just look at history. All the manipulations in the past have failed. Again, IMF, U.S. dumping, English dumping, Switzerland dumping, the London gold pool of the 1960s, they all failed. And the one that's going on now will fail. So, patience is a virtue, as they say, but that's the first thing. The second thing is any manipulation. We talked about all the paper forms of manipulation, gold futures, gold thing, unallocated gold forwards, etc. And yeah, they're very powerful, but they all require some physical gold. Not a lot, maybe less than 10% of all the paper transactions, but you need some physical. And the physical is rapidly disappearing into Chinese vaults where it will not see the light of day for a very long time. So that puts a limit on it. And again, we mentioned the central banks have stopped selling. And the third thing is there is an end game here. And the end game is when China has enough gold so that their gold to GDP ratio equals the United States. They're not there yet, but once they're there, there's no point in buying more because now you can let the price of gold go wherever it wants. You can let inflation get out of control and you don't lose. See, right now, if inflation took off right now, and price of gold took off right now, China would be left in the dust. They don't have enough gold to ensure the portfolio losses on the treasury side. And if the price of gold skyrocketed and their economy is growing faster than the U.S., they would never catch up. It's a moving target. I mean, they're buying a lot of gold, as much as they can, actually. But since they're trying to maintain a gold to GDP ratio, and since they have the fastest major economy GDP in the world, it's a moving target. They have to keep buying more and more and more. Well, imagine a world where they're trying to buy more and more and more, and the price is going up and up and up. You would never get there. So you've got to keep the price down until China's done. But when they are done, in other words, when they have, let's say, 8,000 tons, then the United States and China can shake hands and both say, okay, we're covered. Now you're on the bus. It's the old saying, are you off the bus or on the bus? Right now, Europe and the U.S. are on the bus. China is not. But once China gets to 8,000 tons, they'll be on the bus. The bus can take off and the price of gold can go anywhere as it did in the 1970s, and the Chinese won't be disadvantaged. And, always bear in mind that the Fed does want inflation. Now, what will happen is the Fed thinks they can dial up inflation a little bit at a time, and if it gets too hot, they can dial it back down again like a thermostat. They're going to find out that they're playing with a nuclear reactor and the whole thing melts down and inflation spins out of control. But we're not there yet. This could be another year, 2 years perhaps. Could be another year or two, and there's going to be a lot of volatility in the meantime. And I'd be the last one to say that the price couldn't go lower. It might, but I have been impressed with the resilience. I think the lower price is a good entry point. China certainly thinks so. And the advice I would give to investors is, You need to don't just look at the tape and don't just listen to the talking heads. You need to understand the dynamic behind it. You need to understand how the manipulation works, what the end game is, what the physical supply-demand picture looks like, et cetera. And once you put all of that together, and I do this in my book, The Death of Money, then I think it's pretty obvious that gold is going to go a lot higher.
Well, thank you, Jim Rickards. Certainly in terms of understanding underlying dynamics, you've been extraordinarily illuminating as always, and it's been great having you with us here today. And thank you to our listeners. You can follow Jim Rickards on Twitter. His handle is @JamesGRickards. And speaking of Twitter, please share your questions for our next podcast. Use the hashtag #AskJimRickards followed by your question. And wherever you post that on Twitter, we'll find your question. We'd love to hear from you. And just a reminder, you can find Jim's new book, The Death of Money, at Amazon or at any good bookstore. Get yourself a copy. And so goodbye for now. Goodbye, Jim, and thank you. And goodbye to all of you listening.